Hey everyone, and welcome back. Today, we're going to unravel a mystery that affects millions of us, probably you included. How did a simple, brilliant idea like the mutual fund get so complicated? And more importantly, what does all that history mean for your money today?
We're about to dive into the absolutely wild story of the mutual fund. And trust me, it's a tale of a fantastic idea that truly changed the world for everyday people, but it also spawned this massive industry that, let's just say, sometimes lost its way. It's a story of two major revolutions, and once you get them, you'll be so much smarter about how you handle your own investments.
All right, so let's hop in the time machine. We're going back to the turn of the 20th century. Back then, the stock market, it was basically an exclusive, members-only club for the super rich. If you were just a regular person, the idea of owning a bunch of different stocks to spread out your risk was, well, it was just a fantasy.
So this guy, Edward Loeffler, he saw this firsthand. He wasn't some Wall Street guru in an ivory tower. He was out there, literally sitting at kitchen tables with regular families. And he knew they needed a way in, a way to build a better future. He dreamed up a solution that was fair, easy to understand, and open to absolutely everyone.
And this was his big, radical idea. In 1924, he launched something called the Massachusetts Investors Trust. It was the first open-end mutual fund. Now, think of it like this. It's a giant pool of money, everyone throws a little bit in, and a professional invests that whole pool in dozens, even hundreds of different stocks. The open-end part was the real magic trick. It meant you could join the pool anytime you wanted, and, this is crucial, you could cash out anytime you wanted, at a fair price. No questions asked. It was a complete game changer.
And I mean, just look at the results. That one simple, democratic idea exploded into a $56 trillion global industry. It helped build the American middle class and completely changed the game for retirement. The first revolution was an incredible success. But you know how these things go. When that much money is on the table, the story rarely stays simple.
Right, so as the industry got bigger and bigger after the war, that original noble mission, it started to get a little fuzzy. A new problem started creeping in, and ironically, it was a problem born from success. Welcome to the go-go 60s. Suddenly, the entire culture shifted. It wasn't about slow and steady growth anymore. It became an obsession with short-term, flashy performance. All you heard about were these hot funds and these celebrity star managers who were treated like rock stars, promising to make you rich overnight. The focus went from serving investors to just chasing hype. And this massive gap opened up. On one side, you had the promise, professional management, easy diversification, a fair shake for the little guy. But the reality, that was turning into something else entirely. We're talking high fees, risky short-term bets, and a whole lot of conflicting interests. The legendary John Bogle nailed it with this quote. It became the classic fox guarding the henhouse problem. See, the fund managers, the agents, got paid more for getting more people to invest, not necessarily for getting those people good results. So their interests, which were to grow the fund and make more in fees, were suddenly at odds with the interests of you, the investor, the principal, who just wanted your money to grow. And this is where it hits you, right in your account balance. An average, actively managed fund might charge you an expense ratio of over 1.5%. Now, I know what you're thinking, 1.57%? That's tiny, who cares? Well, you should care a lot. It's like a tiny termite, silently eating away at the foundation of your wealth, year after year after year. Those little bites compound into a fortune over time, a fortune that should be yours. So you can see the whole arc, right? We start with this amazing, democratizing invention. Then, it gets kind of hijacked by a culture that values profit and performance above all else. This tension, this conflict, was building and building until something had to give. And it set the stage for a second revolution, one that would turn the whole industry on its head. Now, every good story needs a hero, and the hero of our second revolution is a guy who, believe it or not, had just been kicked out of the very industry he'd spent his whole life building. You just gotta love that. John Bogle gets fired after a bad business deal, and what does he do? He doesn't just go find another job. He decides to fight back. He saw how the high fees and the crazy complexity were hurting regular people, and he turned what should have been the worst day of his life into a crusade for the average investor. And his idea was so simple, it was absolutely brilliant. He looked at all the data and realized, wait a second, most of these highly paid genius fund managers aren't even beating the market average, especially after you subtract their fees. So he asked a question that terrified Wall Street. If you can't beat them, why not just join them? Why not just buy the entire market, own a tiny piece of every company, and do it for the absolute lowest cost possible? And how do you think the industry reacted to this common sense idea? Oh, they completely lost their minds. I'm not kidding, this was a real poster. They said it was a surrender, that it was lazy, that it was un-American to settle for being average. But here's the hilarious irony. For most investors who are paying high fees for bad performance, being average was actually a huge step up. And you can see exactly why Bogle's idea was so necessary. Look at this madness. Back in 1951, the biggest companies offered, on average, less than 2 funds. The choice was simple. By 2013, that number jumped to 117. It's like walking into a supermarket to buy cereal, and there are 1,000 different boxes screaming for your attention. It's overwhelming. Bogle was saying, let's just get back to basics. Okay, so this whole story, these 2 giant revolutions, the revolution of access and the revolution of cost, they've led us right here to this moment. They've created the fundamental choice that every single one of us has to make with our money today. Yep, after all that history, all that drama, it really all boils down to this one simple but incredibly important question. This is the fork in the road. Path 1 is active management. You're hiring a supposed expert to pick stocks, trying to beat the market. And for that privilege, you pay higher fees. Path 2 is passive management. You're not trying to be a hero. You're just trying to match the market's return by tracking an index, and you do it for a tiny fraction of the cost. So what does the evidence say? Well, it's pretty overwhelming at this point. Study after study shows that over the long haul, those high fees create a hurdle that most active managers just can't jump over. And investors have noticed. Look at that. People are voting with their dollars, and a tidal wave of money has been flowing into passive funds. Look, at the end of the day, understanding this story isn't about me telling you which one is best. It's about empowering you to ask the right questions. So I want you to look at your own investments and ask yourself this: what am I really paying for? Am I paying for proven, consistent performance, or am I just paying for the hope of it? Knowing the difference between those 2 things, that is the key to taking control of your financial future.
Wow, that was something, right? But don't go anywhere, there's more coming, and it's going to make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
Today, we are going to tackle one of the most important, truly game-changing ideas in modern investing, the simple yet incredibly powerful case for index funds.
All right, let's just jump right in. You've heard the promise a million times, right? It's the bedrock of Wall Street. This idea that there are these brilliant experts, these super smart stock pickers who can, through sheer skill and insight, help you beat the market.
But here's the thing, that promise, it's a huge, high-stakes gamble. Because when you actually pull back the curtain, when you ignore the fancy sales pitch and just look at the cold, hard data, a totally different story starts to unfold. And frankly, it calls the whole game into question.
See, on the one hand, you have this glittering promise of incredible returns. But on the other hand, you've got the stark reality. These expertly managed funds, well, they cost a lot of money. You're paying for big salaries, for research, for constant trading. All those fees act like a constant drag on your returns, a hurdle that, as we're about to see, most of them just can't clear.
And I want to be clear, this isn't just a fluke. It's not like they have a bad year here or there. No, it is a consistent, predictable pattern over the long run. So you have to ask yourself, right? If these highly paid professionals, with all the resources in the world, can't reliably win this game, what chance do the rest of us have?
Well, it was exactly that problem that led a man named Jack Bogle, the founder of Vanguard, to come up with an idea that was, at the time, totally radical. It was simple, but it was an idea that would completely change investing forever.
And here it is. This is Bogle's philosophy in a nutshell. He just completely flipped the script. He said, look, instead of paying all this money to experts to try and find that one winning stock, that tiny needle, why not just own all of them? Why not just buy the whole haystack?
So what exactly is this haystack he's talking about? Well, it's something we call a stock market index. You've definitely heard of the S&P 500. It's not a company. You can't buy shares of S&P 500. It's just a list. It's a list of 500 of the biggest, most influential companies in the US, and it's used as a scorecard, a benchmark for how the overall US market is doing. And an index fund, well, that's the tool that lets you buy the entire haystack in one shot. It's a type of fund that doesn't try to be clever or outsmart anyone. Its one and only job is to buy and hold every single stock on an index, like the S&P 500. And by doing that, it delivers you the return of the overall market. Simple as that.
Now here's where it gets really cool. The whole case for this way of investing, it's not based on opinion or a hot tip or some guru's prediction. No, it's built on something way more solid. Simple, undeniable math.
Okay, stick with me for a second, because this is the core of it all. The Nobel Prize winner William Sharpe explained it perfectly. Think about it. All investors, as a giant group, own the entire market, right? So, as a group, they have to earn the market's return. That is, before you factor in any costs. It's just a mathematical fact. So if everyone starts at the same finish line, which is the market's return, what's the one thing that determines who wins? It's costs. The group that pays less in fees is guaranteed to end up with more money. Active funds have super high fees, which is a massive handicap. Index funds, on the other hand, have teeny tiny costs. As Jack Bogle always said, in investing, you get what you don't pay for. And this simple arithmetic leads to this absolutely staggering result. Study after study, year after year shows that something like 85% of active fund managers fail to beat their benchmark index over a 15-year period. Let that sink in. The math is just relentless. But, this isn't just about charts and numbers. The risk of trying to pick individual winners, it has profound, real-world consequences. A listener of a finance podcast shared this incredible story about how her family had almost all their money tied up in a single stock. Learning about diversification prompted them to move into index funds, and just in the nick of time, before a personal tragedy struck that would have been a financial catastrophe. It's a powerful reminder of what's really at stake here.
And that brings me to a really crucial point. Bogle's idea was so simple and elegant, and it was all about long-term investing. But today, the very tools he created, well, they're often used for something completely different, pure speculation.
There is a world of difference between these two things. Investing is about owning a piece of actual businesses and sharing in their growth over decades. Speculating, on the other hand, is just betting on which way prices will wiggle in the short term, often using ETFs, which trade like stocks all day long.
And if you want to see just how wild it's gotten, get this. The annualized turnover rate for SPY, one of the most popular S&P 500 ETFs, has been as high as 1,380%. That means the average share is being held for just a few weeks. That's not investing, it's a casino, with Wall Street happily taking a cut of every bet.
This whole speculative mindset has also led to an absolute explosion of these niche thematic funds. Index funds that track things like cannabis stocks or AI or whatever the hot trend of the week is. But they are indexing in name only. They totally miss the point. Instead of diversifying your risk by owning the whole haystack, they concentrate it, encouraging you to chase performance, which is the exact opposite of Bogle's philosophy. So, okay, with all this noise, all this temptation to trade and chase trends, how do we get back to the simple, powerful wisdom of Jack Bogle's original idea? How do we avoid getting sucked into the speculation game?
Well, it actually boils down to 3 beautifully simple, timeless rules. First, keep your costs ridiculously low. Remember, every dollar you pay in fees is a dollar that's not working for you. Second, diversify, and I mean diversify broadly. Own the whole world, not just one country or one sector. And third, and this might be the hardest part, stay the course. Tune out the noise, ignore the scary headlines, and just let compounding do its magic over decades.
And when you put it all together, you arrive at this wonderful, kind of beautiful paradox. The overwhelming evidence shows that the single best way to win the game Wall Street wants you to play is to simply refuse to play it at all. So ultimately, it's a choice you have to make. Are you going to play the high-stress, high-cost, and, for most people, losing game of trying to outsmart the market? Or are you going to choose the simple, low-cost, and time-tested strategy of just owning it? The choice is all yours.
Wow, that was something, right? But don't go anywhere, there's more coming, and it's going to make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
Hey everyone, and welcome back to the Vault. Let's be real for a second. Does investing ever feel, well, just crazy complicated? Like it's this exclusive club with a secret handshake you were never taught? If you've ever felt that way, you are not alone. For decades, that's exactly what it was like for most people. But what if I told you that one single brilliant invention didn't just knock on the door of that club, it blew the doors wide open for millions of us? This is the story of how a financial revolution changed the game, and it all starts right now.
Take a good look at this number, $10.3 trillion. That is a mind-boggling amount of money. To put that in perspective, that's more than the entire economies of Japan and Germany combined. And that is how much money Americans have put into just one type of investment vehicle. This isn't just some flash-in-the-pan trend. It's one of the biggest shifts in the history of finance. So what in the world is this financial superpower that has quietly taken over?
You know, things don't get this big by accident. The reason ETFs grew so explosively is because they showed up and offered a solution to some of the biggest frustrations that investors have been dealing with for generations. We're talking about those sneaky, high fees that just nibble away at your hard-earned money, confusing strategies, and that feeling that you're never quite sure what you're paying for or what you even own. For the longest time, if you wanted to be a diversified investor, your main option was something called a mutual fund. And look, mutual funds were great for their time, but they often came with a hefty price tag and a way of doing things that felt a little, well, clunky in our fast-paced digital world. People were hungry for something better, something clearer, more flexible, and frankly, just more efficient. They were ready for a change. All right, so we get it. It's huge, it solved a bunch of old problems, but what actually is this thing that convinced people to move trillions of dollars? Let's get right to it. No more mystery. Let's pop the hood and break down exactly what an ETF is in the simplest way possible.
Okay, here's the absolute core of it. Imagine you're at the grocery store. An ETF is like a prepackaged basket of goods. Instead of having to go down every single aisle and pick out apples, oranges, milk, and bread one by one, you can just grab one basket that has everything you want inside. But here's the truly magical part. You can buy or sell that entire basket instantly with a single click right on a stock exchange, just like you were buying a single share of a company like Amazon. One click, and you own a tiny piece of hundreds or even thousands of different investments.
And this chart right here, this is where you can really see the difference in power and control. Look at trading. With an ETF, if you hear some big news at 10 a.m., you can react at 10:01 a.m. You can buy or sell anytime the market is open. With a traditional mutual fund, nope. You place your order and have to wait until after the market closes to get your price. And the transparency? It's night and day. ETFs show you what they own every single day. Mutual funds? Maybe every 3 months. It's the difference between driving with a crystal clear windshield and trying to navigate through a thick fog.
Okay, so this all sounds amazing, right? But you might be wondering, wait a minute. How does that even work? How can this basket trade like a single stock, but also perfectly match the value of all the thousands of things inside it? Well, my friend, you've just asked the trillion-dollar question. And the answer is the secret sauce. It's a truly brilliant behind-the-scenes process that keeps the whole thing running smoothly. Okay, stick with me, because this part is pure genius. Let's go back to our grocery store. Imagine there's a huge run on those pre-made baskets, the ETF. So many people want them that the price in the store starts to creep up higher than what the individual items inside are actually worth. A big, special shopper, they're called an authorized participant, sees this little price difference. So what do? They don't buy the overpriced basket in the store. Oh no, they go directly to the farmer's market, the real stock market, and they buy up all the individual items themselves. Then they take that big crate of goods to the store manager, the ETF issuer, and they trade it for a huge block of brand new fresh baskets. Then they immediately put all those new baskets on the shelves, and poof, the extra supply pushes the price right back down to where it should be. It's this constant, self-correcting system that keeps prices honest.
So what does that whole complicated dance mean for you and me? It's actually incredibly simple and incredibly important. It means that because these big players are always looking to make a tiny profit from those small price differences, they're constantly keeping the system in perfect balance. It ensures that the price you see on your screen is almost always a super accurate reflection of what the stuff inside the ETF is truly worth. It builds trust.
So now that we've peeked behind the curtain and we understand the clever how behind ETFs, we can really start to appreciate the why. Why has this become the go-to choice for so many people? Let's dive into how all that smart engineering translates into some very real, very powerful benefits for us as everyday investors. And here they are, the big four. First, low cost. I mean, who doesn't love that? Keeping more of your own money is always a win. Second, transparency. We talked about this, knowing what you own every single day. Yes, please. Third, flexibility, the power to trade whenever you need to. But let's talk about number 4 for a second, tax efficiency. This one is huge. Because of that creation and redemption process we just talked about, ETFs often don't have to sell their holdings for cash. They can kind of trade them in kind. By avoiding a cash sale, they often avoid creating a taxable event for the fund, which means fewer surprise tax bills for you at the end of the year. It's a subtle but incredibly powerful benefit over the long run. Now, if you're a visual person like me and you need proof that all these benefits really matter to people, just look at this chart. This is the story right here. Over the last decade, you can see investors have voted, and they voted with their wallets. Look at that massive river of money flowing out of the more expensive actively managed mutual funds, and look at the tidal wave of cash pouring into lower cost index ETFs. The trend couldn't be clearer. This is what real people are choosing to do with their real money. Okay, but let's take a deep breath here. It's easy to get excited, but we have to have a real talk. No investment, and I mean no investment, is perfect. Nothing is a magic bullet, and with all the amazing power and access that ETFs give us, it is absolutely essential that we understand the other side of the coin, the potential risks. And this isn't about being afraid. This is about being smart and being prepared. This quote from the CFA Institute just says it all, doesn't it? Access without understanding can be risky. ETFs have basically handed us the keys to the entire global financial kingdom. It's amazing. But just because you can now buy an ETF that tracks, I don't know, the price of vintage comic books with a single click, doesn't mean it's a good idea for your retirement account. The responsibility is on us, the investors, to actually understand what we're buying. So what should you really keep an eye on? First, there are transaction costs. Even small trading fees can add up. Second, please be careful of the hype train. Today's hot Future of Robotics ETF can very easily become tomorrow's forgotten fad. Third, remember that balancing act we talked about? Well, during really chaotic market days, the price can temporarily drift away from its true value. And finally, and this is a big one, you need to know that some ETFs are built like professional race cars, leveraged and inverse ETFs. They're designed for super short-term trading by experts, and they are definitely not meant for a long-term buy and hold journey. So when you put it all together, there is absolutely no doubt that ETFs have been a democratizing force in finance. They have given millions of people like you and me access to powerful, low-cost, and transparent tools that were once reserved for the very wealthy. But it all leads us to one final, really important question. With this newfound power to invest in anything, anytime, all with a single click, has it truly made investing better and safer for everyone? I'd love to know what you think. Let me know down in the comments. Thanks so much for watching, and I'll see you next time.
Thank you for spending time with us here at the Violet Vault. Don't forget to like, subscribe, and drop your thoughts in the comments below. I'd love to hear from you. Until next time, stay focused and keep growing.